What happens if China decides to ban the export of refined copper products, hypothetically speaking?
Well, I would say that would be cataclysmic to the world. There's just there's just no way that they can, um, they would basically cut off the world supply. And I think when we look at all of this narrative on, say, critical minerals, how China controls it, China does have a disproportionate share of the worldwide metal produced when you talk about copper.
Is the global commodity complex signaling global economic slowdown? We'll find out with the next guest, Olav Langelaar. He is a VP Corporate Development at Gladiator Metals, ticker GLAD, Glad on the TSX Venture. Welcome to the show, Olav. Good to see you.
Thank you, David. Pleasure to be here.
What's happening now with the copper price? Let's discuss what copper is signaling. So here, let me pull up a Bloomberg article here. It says that according to reports, copper is shrugging off global gloom as Chinese buyers are squeezing supply. The global copper market is flashing signs of tightness as strong Chinese buyers buying squeezes scant supplies even in the face of worries about a looming industrial downturn. While copper prices plunged in early April after President Trump unveiled his so-called reciprocal tariff regime, they have since rebounded, buoyed by strong buying from China. Now, according to reports here, apparent demand growth in China has been running near double-digit levels this year, a pace that cannot continue, according to the vice head of trading at Zijing Mining Investment Shanghai Co., a unit of China's top copper miner. Demand will slow in the second half along with output. Okay, let's evaluate that statement. Do you think that this demand right now is sustainable? And per Mr. Lai's comments, demand slowing the second half of the year along with output, does that make sense to you?
It does to a certain perspective. I think what we've seen is post-Liberation Day, we had a fairly strong collapse in the price of copper, which attributable to fears of recession on account of tariffs and leading to a slowing down of the economy. Subsequent to that, we have seen the copper price recover. A lot of the equities in the copper space haven't. However, the Chinese tend to be very opportunistic. And so when we saw this price plummet, I'm sure the Chinese buyers stepped in and picked up copper at a discount. So generally speaking, I think copper to me is reflecting a lot of economic uncertainty, mostly on account of statements made by Donald Trump. And generally speaking, I think there's more fear in his comments than there are actually actions. So he seems to have a lot of bark and little bite. And as we see him unable to enforce or find resistance with his tariffs and his posturing, we're seeing a slight recovery. So I think we haven't reached the pre-Liberation Day levels in the copper price yet, mostly on account because there's still a risk premium associated with the uncertainty regarding his statements.
So let's pull up the copper price chart and take a look at what you're referring to. Like we talked about, there was a huge drop in the price. This is from the COMEX from $5.27 all the way down to $4.15 a pound. It's since rebounded a bit, but not quite back to its pre-Liberation Day high, like you said. How much of this demand was just stockpiling of copper in anticipation of tariffs? In other words, not a real signal for economic growth.
Yeah, I think there was a substantial shift of warehouse stocks from China back into the U.S. In anticipation of copper having a tariff imposed on it. There was talk of it. It hasn't actually happened. There is a bit of a respite. But I think generally speaking, the macro theme is that is the U.S., is the world, the rest of the world heading into a recession on account of Donald Trump's tariffs, and is probably more likely the word is threats. So on account of that, we've seen a slight recovery in the copper price, but I think there's still a lot of fear and uncertainty. We do have strong tariffs out of China still for product coming into the U.S. Now, how much that actually affects directly copper production, I think is yet to be seen and felt.
Is there a reason why Dr. Copper, as it's aptly named in the community, is kind of trailing or following the S&P 500? Here, let me just get a better SPX. There we go. So ever since the beginning of, the middle of March, it's been more or less tracking stocks, at least the S&P 500. Is this a peculiar trend for you, or have you seen this before?
No, I think this is, as you mentioned, Dr. Copper, the economic indicator or predictor of the economy. If you look at, um, I think with the Republicans coming in, there was a general sense that the economies worldwide were going to boom, and then the tariff narrative was imposed, and that put the fear of everybody put everybody into a recessionary fear. I think what we're seeing is as that is subsiding in terms of more bark than bite, the equities are all recovering. The one thing this chart I think doesn't really reflect is that most of the major copper equities have yet to recover to the same level as the S&P versus copper price that you have up here.
Right. So ultimately, then, do you think Dr. Copper is signaling some sort of economic slowdown?
I don't know if I'm going to say it's signaling a necessarily a slowdown because it has recovered somewhat.
Yes.
But I think Dr. Copper is being very cautious and probably somewhat directionless, waiting for the next pin to drop and understand what's happening. So we do have Dr. Copper indicating a muted price. Maybe the previous pre-liberation day pricing was more euphoria in terms of the economies are all going to grow at X%, and that their assessment has dropped, or that belief has
Yeah.
been somewhat tempered by the fear of uncertainty.
Do you have an analyst consensus forecast for the copper price?
Yes, I think generally speaking, we're on this sort of rolling price escalation, and so we have we have sort of three main baskets that are going to drive copper demand and growth.
Mm.
So I think that come roughly 2030, most of the larger houses and forecasters are predicting $5 copper, well up from where we are today. And that is on account of three general themes: economic growth worldwide. So if you look at copper demand, in Japan is about 75% per capita of what the US and say Canada has. Um, India is less than 20%, and copper demand in China is around just under 50% per capita that the US has. So as these economies evolve and people demand the same standards of living and the same access to electricity and electronics, that in itself is sort of a base economic growth. So that's a big portion of the current 22 million pound demand that we have per year. If you add on to that the last 10 years of the energy transition, we've got electric vehicles, we have wind, we have solar, grid, additional storage increases demand. But more importantly, I think what we've seen in the last couple of years is the increase in digital infrastructure. So data centers, 5G, the Internet of all things, and particularly now AI. And to give you a sense of the increased demand, a new data center by Microsoft, I dug this up the other day, $500 million data center requires almost 2,200 tons of copper. So those are going to increase worldwide demand in unforeseen ways by anywhere from, depending on who you talk to 2 to 7% a year. So the forecast is that we are going to need about 50 million tons of copper per year by 2050, and we're currently at 22 million. So we have less than 25 years to more than double our copper output. So all of that just indicates that we need a higher incentive price to put new mines into production and get additional production online.
And people don't understand, or a lot of people don't understand how important China is for the global copper market. Tell us the significance of China in the copper supply chain and why a trade war may impact this supply chain.
Yeah, so I think one of the aspects that most people don't appreciate is that copper is really produced in two forms by mining companies. So 20% of the world's copper comes from what's called SXEW, solvent extraction, primarily an oxide copper, and generally Latin America became very famous for those types of deposits in the early 80s. That led to a significant drop in worldwide grades because it was very abundant. But those deposits, the easy ones, have been found, and so finding an oxide copper deposit nowadays is very difficult. But the biggest driver of copper production are sulfide mines, which are 80% of the world's mines produce sulfide concentrates. Those concentrates have to be smelted to be converted to metal. And that metal is generally produced in China. China now controls 53% of the world's smelting capacity. Nobody in North America, mostly Europe, nobody wanted additional smelters on their lands. China, recognizing that they needed to build infrastructure, needed metal capacity or the ability to produce metal, has spent the last 10, 20 years building their smelting infrastructure to the point where they now control 53% of the world's smelting. So the irony is that China is basically producing, by producing the end product, 53% of the world's copper. Mm-hmm. And so if that copper has to come back to the US, that was the fear of tariffs, because the US and Canada don't produce enough metal with smelting capacity in their own jurisdictions.
What happens if China decides to ban the export of refined copper products, hypothetically speaking?
Well, I would say that would be cataclysmic to the world. There's just no way that they can, they would basically cut off the world's supply. And I think when we look at all of this narrative on, say, critical minerals, how China controls it, China does have a disproportionate share of the worldwide metal produced when you talk about copper. They only produce roughly 40% of the world's copper, and yet they control over 53% of the smelting capacity, which in essence means they control that output.
Is the West or any other part of the world mitigating this risk that you just talked about, this cataclysmic risk of China pulling all the levers potentially on the global copper supply? Do we have enough time to mitigate these risks and hedge with alternate supply chain lines?
I think the answer is no. Generally speaking, our supply chains are so intertwined. And, that started back 30, 40, well, probably 40 years ago with all this just-in-time inventories. Everything moves so seamlessly. So if you try to disrupt any piece of the chain, the world can't respond. I think if you had to build a new smelter, permitting aside, that was probably a 3-year project. Like, these are large, vast industrial complexes. The permitting alone would be 5 to 10 years. So, anytime you have a disruption in that chain, the market can't respond quick enough. So if China were to unilaterally say, that's it, we're not shipping copper, the world's economy would implode. I think there's just no way to live without that amount of copper. So, if you look at, can we increase mine production capacity? Sure, we have lots of projects. We know lots of deposits waiting for an incentive price to actually be built. But having said that, the constraint still becomes smelting. You have to get your concentrates to a smelter that can convert that concentrate to physical metal. China has done actually an exceptional job of building out its smelting capacity. And the current situation is China has about 10% more smelting capacity than the world has the ability to produce concentrates. So there is a surplus of capacity. And if you talk to a number of people in the concentrate and in the copper mining space, they will tell you that this is a perfect storm that has been building for years. A smelter is a large industrial complex. You can't just turn it on and shut it off. You have to basically run them full out, flat out. And so what's happened now is that with a shortage of concentrates, you look at Panama Cobre got shut down, seized by the Panamanian government. It's on hold. That was 1% to 2% of the world's supply of copper. So the way the market works is these Chinese smelters are now scrambling to find feed to keep their smelters running. So what they do is there's a mechanism where when a smelter buys concentrate from a mining company, they charge them a treatment charge, which is just a base charge to say, I will buy your concentrate, but I need $40, $50, $60 a ton to treat it. And then I get a refining charge where I skim a little more off. Treatment charges for the first time in my history or my career that I can recall are now negative. In other words, there is such a demand for concentrate, which is that squeeze you talked about in your earlier slide, that the Chinese are saying, look, we will pay you $40 a ton to give us your concentrates. And concentrates are not as simple as a lot of people think. Only 20% of the world's concentrates meet this Chinese standards. Okay, and really what we're finding is as mines have become deeper and larger, the easy mines have all been found. So it gets more difficult. What we're doing now is we're finding the deeper mines are higher in deleterious elements like arsenic, mercury, fluorine, cadmium, lead. And so the Chinese have blending facilities to blend those nasty elements, the deleterious, to a level that they can withstand to meet their environmental controls. So there's a high demand for clean concentrate. But just the nature of mining and the fact that as we mature our mines, they get deeper, they tend to pick up greater levels of impurities, which are more expensive to treat.
Okay. And now on the long-term demand and supply dynamics of the copper market, going back to your earlier analyst consensus forecast for the price, I've noticed that the price doesn't really tick up significantly until a few years later into this decade. Is that because the deficit that we're about to talk about doesn't really kick into effect until later?
Yeah, I think this copper supply deficit seems to be on this rolling. It's going to happen on a 2-3 year basis. So the current scenario starts to show that we have a deficit in production by about 2027, 2028. And I think what most investors in copper stocks, or actually in all metal stocks, there's not a problem until there is a problem. And then you get a step function in your commodity pricing. So when there is demand for copper, the price will suddenly skyrocket on account of the fact that putting additional production online is incredibly difficult. To give you some sense, if you go back to 2009, the duration or the time that it took, sorry, back to 2005, if you discovered a mine and you put it in production, that timeline was 12 years. When I first started in this business, people would have a discovery. They could put a mine into production in about 3 years. So by 2005, that was 12 years. Currently, the average around the world is 17 years from discovery to production. Additionally, we've seen only 10, I believe, out of the 34 big copper projects put into production in the last 10 years. So there was a forecast 10 years ago that we would have these 34 mines in production, and only 10 of them did. So you can see from discovery of a deposit to actually producing metal, there's an enormous lag. So all these timing inefficiencies are what's going to create significant price appreciation in copper. So when there is a shortage, there will be a big shortage and the price will go up dramatically.
Why is the if you take a look at this chart here, and this is a projection by BHP,
Yeah.
why is the supply dwindling post 2026 in all metrics? So you've got probable brownfield, probable greenfield, and then you've got possible and possible brownfield and greenfield lifetime extensions, all declining around the same time. You know, is there a particular reason as to why, notwithstanding long long times to permit mines and so on?
Yeah. So generally speaking, when mines are built, and this is purely a financial outcome, you pick the best parts of your mine out first. So mines, typically the grades within a mine vary, and you in to maximize your NPV or your investment, your IRR, you typically pick the best parts of the mines out first. So that's very much grade dependent. So every mine or most mines tend to have a high grade component which the operator seeks first. Additionally, as mines age and mature, they get deeper, they're more capital intensive, they're bigger. You need more infrastructure to keep that production rate up. If you think of an open pit mine, the deeper you get, the longer it takes to haul that ore from the bottom up to the top. So you either need more equipment. And so generally speaking, mines are a declining asset. You mine them, and at some point you deplete them. And you try to maintain that production profile, which as you get deeper, as they get bigger, becomes more expensive. So generally speaking, all mines have a declining production profile, which can be offset by additional exploration.
Yeah.
So if you have a brownfield site, you can add more reserves, resources to it. you can extend a life. But generally, they're all declining. So that's a consistent theme.
Why is this chart assuming that the pace of new uh, or the pace of growth of new brownfield and greenfield exploration deposits will not grow at the same extent as the declining profile of existing mines?
Right. So again, it comes down to permitting mines.
Mhm.
You look at there's a big mine in the U.S. called Resolute. It's been in permitting limbo for 25 years. So you have permitting delays, permitting issues. You have, most of these projects that are on the shelf are somewhat ready, have positive economic studies, but they work on paper. And most people look at them and say, sure, it works at spot price, but what we all know that commodities are cyclical. What if copper goes back to $2 or $3? Will that mine still be in operation? So many of these projects are almost academic exercises where they cannot withstand a sudden drop in metal price. And so they're not being built because the risk capital isn't there. I think the other component you have is that capital costs have just skyrocketed. If you go back to the 2000s, if based on a ton of copper output, you could build a mine for $4,000 to $5,000 a ton. By 2012, that was $10,000 a ton. Today, that number is north of 20. It's probably closer to $44,000 a ton. So your capital costs are enormous. Part of that is also consistent with a general decline in grades around the world. Grades have declined by about 40% in the last 20 years. So I think the average worldwide grade is about 0.6 copper now, but there's lots of copper porphyries that are in operation are 0.28, 0.3, 0.18. So there are some lower grade mines that can make it work. But if you get a shock in the copper price, they'll be unable to pay their capital back.
And I guess this deficit projection is not taking into account the above ground inventories of copper, or is it?
Um,
I mean, I'm just thinking like maybe the deposits in the ground, perhaps maybe dwindling, but we still have a large reserve of inventory of copper above ground that may offset this demand gap.
Yeah, I don't think that's a realistic expectation because the
Okay.
copper above ground would be generally processed. That's LME, Shanghai, COMEX inventories.
Okay.
So those are a fairly fluid, first in, first out. That's just sort of, let's call almost like a working capital. That's always being traded and always mobile, but that will not make up for a shortfall. Having said that, when you look at what transpired with the tariff threat, and we saw a rapid run up in the COMEX price. So that is US based copper versus the LME and the Shanghai. And there was an arbitrage of almost 75 cents a pound of copper on account of inventory moving from those warehouses into the US to try to preempt the tariffs. And theoretically, your incentive difference would be about 25% because that's what people thought the tariff would be.
How would an arbitrage even exist in a market as big as copper? I mean, is it not liquid enough for that to just be, traded away?
I think, intuitively you would think it's liquid enough, but I think a lot of this copper gets traded on paper, much like a financial instrument. And I think there
Sure.
was just such a drain on the warehouses and the inventories that it just shocked the system. We did see a similar situation where nickel spiked about 2 years ago when one of the Chinese traders was exposed with copper, couldn't fill his demands or the orders he had, and he had to buy in the market. So the markets are very efficient, and therefore I would say very tight and in some respects constrained and unable to withstand a shock.
Let's talk about the mining industry now. So, notwithstanding this demand gap that we're about to see, I think investors are, supply gap rather, I think investors are wondering what the industry is going to do over the next 2 to 3 years to at least try to meet this deficit.
Yeah, so I think the industry needs to produce more copper. However, the reality is we need an incentive price to put mines into production. And when we see a somewhat muted price, particularly when we see one that became very volatile, the market doesn't like that uncertainty and investment decisions don't get made. So at the end of the day, we need to see a higher price to incentivize these mines to go into production.
Yes. Well, the mining industry, I'm talking about gold mining and silver mining, has been kind of lagging behind the bullion price for gold and silver over the last year and a half. It's just starting to catch up. Um, what about for the copper mining side as well? What's the narrative behind copper equities, and why people should be looking at copper equities now?
Yeah, so my view is let's back up a little bit. We'll talk about the gold. As we discussed the other day, gold equities have essentially moved in step with the commodity price. We haven't seen the leverage we traditionally see. I think a big part of that is there is still an enormous amount of capital tied up in, call it the Magnificent Seven. And there are times where we've seen shocks in the Magnificent Seven, like on an individual basis, where their decline in daily value is almost the entire market cap of one of the major gold producers or a major copper producer. So we're looking at very different, fundamentally different animals in terms of size. The mining industry is a mere fraction of what the technology companies are. So pivot that to copper. The reason I'm bullish on copper, particularly copper equities, is we've seen the dramatic price drop in copper. We've seen it recover somewhat. Most of the equities of the major copper producers are still stuck at the level when copper was down to, 4.30 or $4 when we first had the price collapse. So if you look at all the major producers, they're off still 25, 30%, although the copper price has started to recover. So we now need more of an investment thesis by that generalist money to look at that contrarian view and say, look, copper equities are still trading at below where they were at this current spot price, and so there's an opportunity there. Layer on top of that when we do get a shortage, my experience is we have equities respond in a step function. They rarely go up nice and slow over 10 or 15 years. What they do is they step up very rapidly. So you get a sudden shock in the system, you get a price spike, and then the equities rocket. So now is a good time to position yourself for this upcoming shortage that should manifest itself in the next 2 to 5 years. And then you will see the copper price respond accordingly, and hence the equities will run.
What sets Gladiator Metals apart? Let's talk about your jurisdiction, your project, and in particular the grade of your deposit.
Yeah, so Gladiator Metals is busy exploring a very prospective belt near Whitehorse in the Yukon. We have a 35-kilometer high-grade copper skarn belt. The land has been privately held for 40 years. We're the first to do meaningful exploration. One of the things that attracted me to Gladiator when I joined is our grades are spectacular and near surface. So we're hitting intervals of 7, 8, 9, 10% copper. We have broad widths. Our objective with our Cowley Park prospect is to try to get a 40 million ton resource in the next 6 months, hopefully greater than 1% copper plus credits. So we have silver, gold, and moly credits. The significance of grade is we have a saying, grade covers all sins. So when you have high grade, particularly 1%, almost double the world average, if we can achieve that grade, this mine will be very robust and able to withstand any turmoil in the market. So what you want is the higher your grade, the higher your margin. Additionally, by having high grade, on a unit basis, if let's just take for argument's sake, the world average grade is 0.6%. If your deposit is 1.2%, you only need to move half as much rock to get that unit of copper out of the ground. So you save 50% on mining costs, you save 50% on milling costs, your capital decreases because you have grade. So grade is a very strong and attractive feature. So our objective is to drill off our Cowley Park prospect, get to something north of 40 million tons, and we're hoping we can achieve a greater than 1% copper plus credits. And additionally, the rest of the belt is very prospective. There are old historic mines along the belt. There's lots of mining has been done historically. And our objective there, or we believe we should be able to get to 100 million tons in the next few years.
I want to come back to the belt in just a minute, but take a look at my screen right now. What are we looking at now, Olaf? Let's discuss this slide and why this particular jurisdiction is so unique because, like this chart demonstrates, it's not, or this slide rather, it's not common to find grade of this caliber.
Yeah, exactly, David. And so when I joined Gladiator, look, I've spent the last 25 years in banking, financing many companies around the world in all commodity sectors. I spent almost 10 years working in mines around the world. And so when I came across the Gladiator opportunity, I was quite surprised at the grades and thinking, wow, this is very unique. So I ran a screen through, public information through Capital IQ, and I found out that I said to myself, how many deposits in the world have a 1% headline copper grade? And it has to be undeveloped because there are a number that are in production that still have that kind of grade. So from an undeveloped 1% headline copper grade, there are 158 projects in the world, according to the screener that I used. So I got rid of the smaller ones. A 5 million ton operation or 5 million ton resource is rather small. There were 75. So basically, the world of undeveloped 1% copper projects is 22, greater than 40 million tons. That's a meaningful deposit. And when I went through them and sort of made a bit of a subjective analysis, I found that only 4 of those 22 deposits are amenable to open pit methods. And when I looked at which ones they were, the list, this Mes Aynak in Afghanistan, it's actually a JV between Metals Mining China and the Taliban. So it's kind of a conflict asset. It's a historic site, likely not going to get built, particularly as an open pit. Kalakundi is a conflict asset in the DRC. It's in all kinds of turmoil. So that really leaves us with 2 other deposits in North America, San Nicolas in Mexico and Arctic in Trilogy. So really, if we can achieve our objective, which is 40 million tons at 1% or better, we could be in very select company. We could be in one of 5 deposits undeveloped in the world. And then if you take the conflict assets out, we could be a top 3, which would make it a very desirable project on account of reduced capital intensity, reduced cost to operate, and good jurisdiction. I mean, the Yukon is a strong mining jurisdiction. There's a lot of talent there. There's good infrastructure, and it should be a very promising prospect.
All right, so here is the belt. I'll just leave this chart up. Uh, what um, what is the timeline to achieve 40 million tons?
Okay, so we're busy drilling right now. We've completed 4,300 meters this year. We have another. The total program for the year is 28, maybe 29,000 meters. We're fully funded. We have $18 million. Well, we're down to 17 million now because we've completed about 4,300 meters of drilling. So fully funded for the year. Cowley Park is our highest priority. We're busy drilling there now. As a matter of fact, the drills are going to commence here. We had a spring thaw. Will commence in the next day or two. And our objective is to have a 43-101 compliant resource, likely released by late Q1, early Q2, 2026. So, uh, you know, uh, by the end of the year, we'll have a pretty good understanding of it internally, and then we have to go through the QA QC process with a QP and have our resource out in the early part of 2026. So a lot of our efforts are focused there. But what I want to do is I'd like to talk a little bit about the rest of the trend. So we have the Chiefs trend, where there were 2 small mines, an underground and an open pit called Middle Chief and Little Chief. And Hud Bay ran an operation there for 15, 16 years, was probably the primary economic engine of Whitehorse back in the day. And they mined 8.5 million tons of 1.5% copper, 0.75 gold, and I believe 7 grams of silver. And that produced an incredibly high grade, but more importantly, a very clean concentrate that was in high demand all around the world for smelters. That project still has residual resources around it. We are going to spend some time drilling there this year, a little bit of scout drilling, but to understand the geology. And the objective at the end of this year is to get what we call the Chiefs trend into the same sort of level of finish or advancement that Cowley Park was at last year, which is we understand the resource. Not the resource. We understand the geology, and we're going to try to form a resource there in the upcoming years. So that is the second leg of the stool. The
Mhm.
third leg of the stool is the Arctic Chief trend, which has some really spectacular grab samples, some very interesting drill holes, but is again one step earlier than Chiefs. And so if we can get Arctic Chief into a status of where Chiefs is last year or a couple of years ago, understand the geology, define targets, and then add additional drilling, we hope to add more resources there. And when you look at the size of each of these trends, Cowley Park right now is about 700 meters long on strike, and it seems to be, it still is open in all directions, and we are extending it. The Chiefs and the Arctic Chief trend are both between 1.5 and 2 kilometers long, so very prospective ground.
What happens once you achieve 40 million tons in deposits? Are you going to sell your assets or keep expanding? What's your long-term vision here?
Well, I think the long-term vision is we want to understand what we have, and that's a very fluid process. So I think if we reach 40 million tons and we still recognize that our deposit is open along strike or at depth, and then again, it's also contingent on what is the market willing to fund, then we will continue to advance the deposit. So we have a come the end of the year, I think we need to make a decision of, is this still going to grow? And my own personal view is that if it does, we should continue to grow it
Hmm.
and understand the largest deposit we have. Uh, and post that, then we have to start going into economic studies, and that could be, we have PEAs, we have preliminary economic assessments, we have pre-feasibility studies. Those in itself can take 2 to 3 extra years. So we need to continue to de-risk. So the resource is really just the first step to make a determination of how would you advance. So you will look at it when you understand what you have and make the next decision.
Okay, and take a look at my screen one more time, Olaf. This is the slide highlighting the share structure. Just briefly walk us through what we're looking at and who owns what.
Okay, so David, we have about 79 million shares outstanding on a fully diluted. It's 94 million. Um, One thing that you want to be mindful of is we still owe 11 million shares. So that 94.7 million will be closer to 105.7 million by the end of 2029. So we have a joint venture, or an earn-in agreement rather, not a joint venture, with the Coin family who vended the assets to us. It was a 12 million spend over 2 years, 6 years. We completed that in two. And so we still have another 11 million shares to issue. We're at 17 million of cash as of April. We do have a number of warrants here that at 90 cents due in June of 2025. So our shareholder base is primarily management advisors and high net worth individuals. There are some very strong holders here, Toronto, Vancouver, very mining centric, strong technical people who own the stock. We also have strong support from roughly 7 institutions. Mackenzie Investments out of Toronto and 1832 Asset Management, which is dynamic, are big supporters of us, in addition to 5 who I can't disclose. And then we have a retail following of 32, and the coins are the vendors at 8%. Analyst coverage is Joe Mazumdar at Exploration Insights, George Ross at Argonaut, and Barakat Bear at Beacon.
Okay, and then finally, tell us a little bit about yourself and your professional background leading up to your involvement with Gladiator Metals.
So, David, I grew up in northern Manitoba. I'm the son of a geologist. As you can tell, geology is not my strong suit. You should probably listen to my father more. So mining has been in my blood. I've been in it all my life. I started my career actually as a mechanical engineer, but I always gravitated to mining. So I've been in mining and operations, construction, project management for the first 8 years of my life. Or my career rather. I worked for Teck Cominco. I worked in the smelter. I worked in gold mines. I spent some time with Cameco in uranium mines and started up the Kumtor gold mine in Kyrgyzstan, as well as a short stint at Banskoy, which was the Agri and potash mine. So after those 8 years of operations, I went back, did a finance degree,
Yeah.
and then went into the banking route. So I've been in investment banking for about 15 years with an additional 5 years at Placer Dome in corporate development and treasury. So it's given me a very well-rounded background in financing, advisory work, and being able to decipher a good project from a concept. So when when I came across the Gladiator opportunity, they were in need of a bit of help. And like I said, I'd never seen anything with these kind of grades before. And I thought, wait a minute, this is a good jurisdiction. Victoria Gold was at its peak in terms of the negative sentiment. So that was also a bit of a contrarian play. I thought that'll work itself out in time. So my objective was get involved with a project that I believe has the potential to be a mine. And that's more than you can say, probably about 99% of the projects out there. And hence my move to Gladiator.
Okay, Olaf. Excellent. What's the next piece of news coming out of Gladiator we should be watching out for?
Yeah, so look, we still have a number of holes in the hopper. Assays are coming in. We've made a very concerted effort to keep the news flow and the momentum up for the rest of the year. So we've been on track. I think we've done 2 releases. We'll have another news release coming out shortly, hopefully next week. And then try to keep a cadence of every sort of 2 to 3 weeks, consistent news flow all the way through to the end of the year. And like I said, we still have 24,000 meters of drilling to be done. And hopefully, we're at Mother Nature's mercy, but we also have a strong technical team, and hopefully we'll continue to expand the resource or the potential resource and expand the prospect at Cowley Park. Notwithstanding that, we should have, we have about 8,000 meters of drilling planned for the trend. So the Arctic Chief, the Little Chief, Best Chance, Grafter, these are all the highly prospective targets. So we're just going to try to understand those with about 8,000 meters of drilling in 4 different pods.
Mm-hmm. Great. Thanks very much. We'll put the links down below where we can follow the company. Thank you for your time today, Olaf. We'll talk
Thank you,
again soon.
David. Appreciate it.
Thank you for watching. Don't forget to like and subscribe.